the setup is not that bad. And now you may argue back and say that, okay, it was a flat Monday, it was just about okay Friday. But look at the world. I mean, there is a geopolitical tension in the world, and financial markets globally, they have just ignored and they've just moved on. So it's not only India, but globally also there is more green than red. So if you frankly ask me, the path of least resistance for market is actually on the higher side rather than on the downside. That is the trade setup. But if one looks at the internals of Indian market, which is what you look at, let's say the premium for Nifty futures, it has suddenly vanished. The positioning of retail and FI in the FNO market, which is the retail in the FNO and institutional in the FNO, it's almost even Steven. So as of now, there is no element of excitement. There is no panic. This is where markets are simply marking time. They are taking each stock as it comes. For example, we saw in case with IT that it was a very stock specific adjustment what happened in the market right now. The landscape is not bad at all. The ingredients in the melting pot are indicating that market has a bullish mix rather than a bearish mix. So even if markets, they consolidate here, looking at the bias what currently it has, I think the natural course for direction is that markets are inclined to go higher rather than lower. I mean, if somebody tells you that, okay, I was on a 1 week holiday, I suddenly come back and the headlines which are greeting me are big war and a big tension in geopolitical geopolitical tension, crude going back to $90 plus, FI selling for 13-14 days on a trot now, not very exciting commentary from Indian IT companies which in a sense make 15-20% of the total weightage, and then if you have to guess the Nifty, then you would actually be guessing a level of 18,500 or even 19,000. Yeah. Where are we? We are at 19,800. So the ability of this market to shrug off bad news and climb the wall of worry, I think is absolutely remarkable.
Yeah, and other than retail and DII, it's only actually FII which are skewed towards short positioning. But both retail as well as DII strongly in favor of longs.
And you know, with FIs, it's always the interplay of what you do in the cash market versus what is happening in the FNO market. It could be hedging, it could be commitment change, it could be, you know, tactical trades, what they have. But the heart of the market, I think, is still with retail. Yeah. It is still with DI. Those are the folks who actually have cash. See, FIs are opportunist. They will invest and they will buy and sell depending on what the global mood is and what the global averages are. Retail is where the flows are strong, and DIs is where the commitment is strong. And those folks are not throwing in the towel yet. What I don't like about the market right now, frankly, is that there is just no, even though Nifty is not far away from an all-time high, there is just no inertia. There is just no momentum. There is no just commitment. So markets are feather light. Looking at the technicals, I think that path of natural course of natural direction is on the higher side. So as markets go higher, commitment levels will come higher. But at 19,800, when we're talking about a breakout, you want slightly more elevated commitment levels, which is missing, frankly, in my book.
And the path of least resistance is on the upside. That's the verdict. But if you look at the FI flows, yes, into India directly, there have been a bit of a dwindling of the FI flows because almost 18 sessions out of 19, we have been seeing an outflow as far as the cash volumes are concerned. But if you look at the kind of data that we are getting from ETFs which are listed in the US, it does seem like that India is leading the emerging market ETF inflows. In fact, if you look at the total assets, they rose by almost $294 billion. And if you look at the total breakup as well, the total inflows have happened largely in the stock ETFs, and within that, it's India which is leading the pack. India has actually seen inflows of $132 million. And even if you look at the other net inflow data as well, whether you compare it to the likes of South Korea or Taiwan, or even the other emerging markets like Vietnam, Thailand, China, of course, India stands tall and by a massive margin, Nikunj. So if you look at the verdict in terms of the emerging markets, clearly India comes out as the favorite.
So, Anisha, look, I mean, this is something which is yesterday's data, but it will be tomorrow's trend. When I say it is yesterday's data, which is that, you know, the way Indian markets are getting lion's share of inflows, both for non-India dedicated and India dedicated, I think it is important for us to, you know, flag it off. But if this is yesterday's data, then what could be tomorrow's trend? Well, tomorrow's trend really could be that typically when ETF flows, they come back, they will go back into heavyweights. So if ETF flows, they come back, are we in that phase where one last hurrah before the year ends, will happen in HDFC Bank or in ITC or in Reliance. Because typically what you actually see is that ETF always is a weightage stroke a country denominated flow which normally moves into large cap stocks. The interesting bit for me is that, and just stay with this guys, is that Saudi Arabia has got net outflows when crude has gone higher. Right? I mean, you should have thought the other way around. Saudi Arabia would benefit, right? They've got outflows when crude is going higher. I mean, Saudi Arabia is largely Aramco. So Aramco has got outflows. So the world is telling you that, look, nobody is very worried about geopolitical crisis. Crude has moved in a measured manner. It's too small and too myopic to have a financial disruption. Of course, it will have political compulsions. US President Biden, I was reading in the morning, he would be going to Israel. Soon you will see more and more, leaders, they would be now taking sides here and there. So the political narrative, I think, is going to be keeping everyone occupied. But from a financial market standpoint, I think it is time to just move on.
Well, we will move on, but not before reacting to HDFC Bank, and of course the other big heavyweight is Bajaj Finance. It's a bit of a mixed bag, if you ask, from HDFC Bank. While most brokerages are upbeat about the 12% PAT beat, margin gain, of course, they're saying that is going to be the next deliverable. In that sense, the core operating profit was pretty much in line with the street estimates there. Most brokerages are expecting the NII growth to re-accelerate from here onwards. But the question, for 34 months of underperformance that HDFC Bank has had, can the elephant finally dance on this earnings performance?
See, the elephant is getting ready to dance. They have to get the rhythm right. I don't think it's going to be dancing based on these numbers. I think they just have to identify the right tango number or the right salsa number. I look at HDFC Bank very differently now. The room for negative surprise in HDFC Bank is over. So whatever could go wrong in HDFC Bank in terms of liquidity ratios, financials, the merger, challenges, all that is actually behind us. So the negative surprise from HDFC Bank, both in terms of communication, in terms of numbers, in terms of ratios, I think is unlikely to come. Now, that will restrict the downside for HDFC Bank because the negative surprise, for example, came when the analyst meet happened. There was nothing great which came out again in the quarterly update. So even though numbers are unlikely to warrant a big upgrade, and which is what I'm going through in the morning when I'm crossing some of the reports, checking some of the reports, no big upgrades. But from a market standpoint, I think it is reaching a level where valuations are attractive and it is reaching a point where the scope for negative surprise is unlikely. So you pretty much know that if the scope of negative news and number surprise is unlikely, and if the stock has underperformed, then you would like to say that, okay, this is the base at which the stock is just about getting ready. Now, when will the elephant dance? This quarter, next quarter, I don't know. But all I can tell you is that a year from now or 12 months from now, I think we would be using this phrase that HDFC Bank was an elephant which took its time and finally decided to do the tango. It's like, it reminds me exactly like SBI.
Yeah.
For years it did nothing, and then 3-4 quarters numbers came in, everyone said, oh my God, how did we miss it? It is cheap. The same thing is going to happen.